Hello, welcome back to Mali Investment Talks, hosted by me, Joseph Areu. I am an independent financial advisor, and I will be talking to you as often as possible on the subject of making your money work for you, making your money do some work for you as you do whatever it is that you are doing in life. Up to this point, we've talked about, short-term investment, but in the last episode, I introduced you to another investment objective or goal, and that is the goal of investing for an income, a long-term, reliable source of income. Today, I want to talk specifically about one of those investments with the purpose of earning a regular, reliable income, and that is bonds. Bonds as a source of investment income. So, briefly, what is a bond? You remember when I talked to you about treasury bills as a short-term investment instrument? Remember I told you that a treasury bill is basically a loan, a short-term loan, 1 year or less, to a government. Today, talking about bonds, a bond is another loan, but not short-term. It would be a loan for a period longer than 1 year. If it is a treasury bond, or a government bond, then it will be a long-term loan to the government. We call them treasury bonds, meaning you are lending to the treasury of your government. Okay? That is basically what a bond is. So in return for you giving the government a certain amount of money, the government does a couple of things. One, they'll guarantee you a payback of your money after an agreed period of time. So it could be a 5-year bond, could be a 10-year bond, meaning if it's a 5-year bond, after 5 years, you'll be paid back what we call the face value of your bond. Number two, the government will guarantee a regular payment of what we call a coupon. And this is essentially what the income is. So this would be a certain payment. In simple, loose terms, you would call it an interest, usually paid twice a year, so after every 6 months, at a defined rate of payment. So you could be told that, the coupon of your bond is, for example, 10% or 15% per annum. What that means is that they will pay you half of that 15% every 6 months. And when they say 15%, or whatever percentage it is, it's a percent of the face value, the total amount that you'll be paid at the end of the bond period. So those are the basic features of a bond. It's a loan to the government for a defined period of time, which is usually more than 1 year. You can have a 2-year bond, you can have a 5-year bond, you can have a 15 or 20-year bond, depending on which country you are in, okay? And the bond will pay you every 6 months. I'm talking about the government bonds. Every 6 months, they will pay you what we call a coupon at a defined rate. A coupon is like an interest that you are being paid at a defined rate. Of course, less whatever tax is applicable to your bond. So I would like us to go through, in order to understand the typical cash flows of a bond, I want us to look at a spreadsheet which demonstrates an example of a bond and shows us what cash flows you would expect. In other words, what payments you would expect to make and what cash receipts you would expect during the life of that bond. Okay? So, suppose that at the beginning of next year, in January 2023, the government issued a bond and you invested or you took up a bond worth in face value 10 million shillings. This is Uganda shillings, or it could be Kenya shillings if you like. All right? Bonds are usually priced. Now, the price of a bond means if 10 million shillings is the amount that you expect to be paid at the end of the bond period, that's what we're calling the face value. Sometimes it will be, some people will refer to it as the future value, because it will be, that's what government will pay you at the end of the period of the bond. The price of the bond tells you how much are you going to pay government today at the time you're buying this bond. And usually it is quoted in terms of how much you are paying for every 100 shillings of the value that you will get at the end of the period. So you can think about it like a percent, the percentage of the total value that you'll be paid, or the face value, like I said, that you'll be paid at the end of the bond period. So if it says 100, it means for every 100 shillings of that value, you will pay 100 shillings today. So that means if you are expecting to be paid 10 million shillings at the end of the period, then you should deposit 10 million shillings with the government today. Okay? Suppose the coupon rate is 15%. Remember, coupon rate, you can loosely call it interest rate, but basically that is the amount that the government will pay you per year during the time that you have lent them money. Think of it as some kind of a rental. Okay? Government is renting your money. All right? Before they give it back to you, they have to pay a rental. In this case, it is paid every 6 months, but it's quoted annually. So in this case, the rental rate, if you like to call it that way, is 15%. But we call it a coupon rate. The withholding tax will vary from country to country. In Uganda, at the moment, the withholding tax rate for a bond with a period less than 10 years is 20%. That is the tax on the income, on the coupon. Okay? And finally, assume that the maturity period, the period of time over which you will be investing is 5 years. So that means if you are investing in January 2023, then this bond will mature. In other words, you'll be paid back your face value in December 2027. Okay, so let's look at the cash flows. So in January, you will have to deposit 10 million shillings. In June 2023, that is 6 months from the time of your investment, you will receive your first coupon. Remember I told you the coupon is essentially your income, and it's at a fixed rate. And this rate in this case is 15%. This is why this is called fixed income. The rate of income is fixed. So in June, you'll receive your first coupon, and that will be a half of 15%, all right, of the face value. So that comes to 750,000 shillings. But remember, you also have a tax. So they will withhold a tax at whatever rate is applicable in the country where you live. In the case of Uganda, because it's a 5-year loan, you will be charged a tax of 20%. So the government or whichever agent is handling your loan will withhold a tax of 150,000. So your total receipts in June will be 750,000 minus 150,000, and that is 600. In each of the subsequent 6-month periods, that essentially will be your total receipt. In other words, you will get a coupon of half of 15%, that is 750,000, and they will withhold the tax at the rate of 20% of whatever rate is applicable in your country, and you will get your net income of 600%. That will continue until December 2027. Remember, December 2027 is the year of maturity. That's the year when you will now be paid the face value of 10 million. And there's no tax on that, by the way. That's your money, it is not taxed. However, you will also still be owed the final coupon of 750,000, and there will be a tax on that coupon of 750,000, and that tax will be again 150,000. So the total income that you will get, or total payments, total inflow you get from your bond in December 2027 will be 10 million plus 750,000 minus 150,000, and that is 10,600,000. That briefly is how a bond works. Remember always, if you want to understand a lot more, if something is not clear, you want to clarify something, use my contacts, give me a call, send me an email, send me a WhatsApp, and we can discuss more. Otherwise, for today, thank you very much.